someone to the Rebel Capitalist Show that I have an immense amount of respect for. He's an icon in the investment world, in the gold world. His name is Rick Rule. I'm sure you all know him well. Rick, thanks for being here.
Well, George, with that generous introduction, the best thing I could do to save my reputation would be to shut up.
Well, we'll just assume that you've got some great insights, which I'm sure you do, Rick. So let me start. I'm just going to try to throw as many questions at you and just pick your brain, because I'm sure not only my audience, but I'm more so doing this for selfish reasons, to be honest, that I'm just really fascinated to have the opportunity to ask you questions. It's really an honor.
Thank you.
First and foremost, I wanted to get your opinion, because I know you've done so much research, on how gold typically performs in times of inflation or deflation in terms of its purchasing power.
Well, ironically, it appears that gold does well during any period of time when faith in the monetary system is attacked. It's more conventionally thought of course, as a mechanism for defending oneself from inflation. But it's worth noting that over 1,000 years at least, gold has been unique in that it's a medium of exchange that is also a store of value. It isn't a promise to pay, but rather payment in itself. And in some cultures over time, when the crisis of confidence occurred as a consequence of deflation, where that deflation was accompanied by illiquidity, and a lack of confidence in specie or fiat currency, gold has done well too. The only real analog we have to that in recent history, of course, was the Great Depression, where gold did well as a consequence of being repriced by fiat. The suspicion is that had gold not been made illegal by Roosevelt, that the market for gold would have done very well, because trust in the financial system and trust in the US dollar at that point in time was very weak. But in fact, we didn't have the opportunity to test it because gold was repriced higher by fiat.
Right. So that brings me to one of my next questions, which is, throughout your experience, what do you see as the main driver in gold price, either up or down? I really enjoyed a recent interview that you did with Real Vision, where you talked about the anti-gold being the 10-year treasury. And that's kind of the safety play. And you kind of juxtapose that to gold. But do you think that is the main driver for the price right now, as far as the real interest rate? Meaning, right now we've got negative rates when you look at them in real terms, and so that is more attractive for gold. Or what do you think? I don't want to put words in your mouth there.
In my lifetime, it would appear that the most important determinant of the gold price is the broader market's faith or lack of faith in fiat currencies. The most important fiat currency in the world during my lifetime has been the US dollar, the de facto reserve currency of the world, by which all other financial pieces of paper have been measured during my entire career in financial services. When confidence is high in the US dollar and the US 10-year treasury, gold, which is primarily, in my experience, an insurance asset, is weak. Conversely, when faith in the US dollar fades, the gold price has done very well. What's interesting about the period that we're in right now, or at least what interests me, is that we have had for 18 months a strong US dollar and strong gold prices. The only time before in my career that I remember seeing this was in 2001 until mid-2002. My suspicion is that many investors worldwide regard the US dollar strength not so much as a function of a very robust US economy or faith in this administration or an administration to come, but rather the comparative strength of the US dollar relative to other fiat currencies. I also find it interesting that confidence in the dollar and other fiat currencies, confidence in the system, remains strong enough that central banks and central government controls have been able to keep interest rates artificially low, in some senses in negative terms. And my suspicion further is that the fact that both gold and the US dollar are strong simultaneously, which is a rare event, is a function really of the extraordinarily low interest rates available on savings instruments worldwide, but especially the US 10-year Treasury. If you think about the US 10-year Treasury, as of the time of this interview, I think it's yielding about 1.85, 1.87. The Congressional Budget Office suggests that the underlying inflation rate of the United States, which is a different way of saying the official rate at which the dollar is depreciating, is about 1.6%. So the value proposition offered up by the US 10-year Treasury is that the US government will pay you 15 basis points. My friend Jim Grant famously calls this return-free risk.
Right.
So what's happening from my point of view is that gold is competing with return-free risk, a fight that over time I suspect it can win.
Yeah, exactly. Very well said. And no one says it better than Jim Grant, right? It's just, he always hits the nail on the head with that. So if usually gold has a negative in the sense that there's a carrying cost.
Right.
But if we basically now have a carrying cost on all other flight to safety assets, whether it's the dollar or the 10-year, then now all of a sudden, well, what's the knock on gold? Therefore, once this kind of dawns on people, you would think that there would be more of a migration or capital flow into gold. And on that note, I remember a recent interview you did where you talked about the average investor portfolio. Now, this is from, I think, institutional investors. I don't know if this is the public. You can correct me if I'm wrong. But throughout history, they've had about a 2 or 3% allocation to gold. And at times, over the past 30 years, that's actually gone up to 7%. And right now, it's only, I think, 1%. And you were saying that if that 1% just goes to 2%, that potentially takes the gold price from where it is today up to like $4,000-$5,000. Was I correct in understanding that?
The study suggests, and it isn't just institutional investors, the study suggests that the asset class of precious metals, that is physical precious metals and precious metals securities, comprises between 1/3 and 1/2 of 1% of the savings and investment matrix in the United States, looking at all savings and investment products. The peak in 1981 was alleged to be around 7%. If we had mean reversion, which is what I am suggesting is a probability, what would happen would be that demand for precious metals and precious metals related securities would somewhere between triple and quadruple in the largest investment market in the world. I'm not one of those who suggests that you're going to see a total collapse of the US dollar and an abandonment of the US economy or anything like that. I'm not suggesting that gold is going to win the war against the US dollar. I'm just suggesting that gold is going to lose the war a lot less badly.
Right. And one thing I talked to Eric, is a buddy of mine with Macro Voices. I've heard you on there several times, and he pointed out the fact that even if gold were to go to, let's say, 15,000 an ounce, and it was completely a result of inflation, so it just went up to that high, just in nominal terms. He said what people forget is that you'd still have a capital gain on that. So once you paid the tax, if you cash out, then as far as purchasing power, you're actually losing purchasing power. And the reason I bring that up is because I think it highlights a point that you made when we first started talking, that although gold is fantastic, I think it's an absolute must in everyone's portfolio. I more see it as insurance than I do a speculation on the absolute price or purchasing power increasing. And it sounds like you kind of see it the same way. Am I correct to assume that?
I completely agree with you. A financial planner who looked at my portfolio would say, as a consequence of my profession and a consequence of the fact that I'm the largest shareholder of Sprott, that I have enough of an indirect interest in Sprott that I shouldn't have gold as an investment.
Right.
I don't regard it as an investment. I regard it as insurance. I regard it as an extremely good, uncorrelated form of liquidity. The truth is, at 66, almost 67, gold is an instrument that helps me sleep nights and stay calm. A luxury, perhaps, in the sense that insurance for people who might be able to afford to self-insure is a luxury. But I certainly regard the metal as insurance and the shares as either investments or speculation, depending on the nature of the shares owned.
How does that compare to silver? Do you see it as more of a speculation or more of insurance?
No, I see silver as a more speculative instrument. Gold for 1,000 years or more, for one reason or another, has been simultaneously a medium of exchange and a store of value. Silver is much more volatile, up and down. And because of its lower unit cost, it's accessible to more investors. So, as an example, in South Asia, rich people might store their wealth in gold, but the rural peasants store their wealth in silver as a consequence of its lower unit cost. The result of that is that, at least through my career in precious metals, which goes back to the early 70s, gold has moved first on fear buying. When the momentum has been established by the fear buyers, some greed buyers move into gold, but more greed buyers move into silver. And then, of course, the most volatile precious metals asset that I know of are the silver shares. Silver itself is extremely abundant, but high quality silver shares are extremely rare. Later in a bull market, what seems to happen is that as the generalist investors come into precious metals, they become less attracted to the insurance aspect of precious metals and more attracted to the momentum and speculative aspects of precious metals. And there's no more speculative asset in the world than silver stocks. When the generalist money comes into the market, what happens is that the limited market capitalization available in decent quality silver shares is so constrained that, as my friend Doug Casey says, the flow of funds resembles attempting to siphon Hoover Dam through a garden hose.
That's a great analogy. Yeah. So now that we've established that, I know there's quite at least the last time I looked, this was a couple weeks ago, that ratio of the gold price relative to the silver price, or should I say the silver price, was very low. Gold was a lot higher, I mean, double than where it is now. And I even looked at kind of going back to 80 and 1970s, and it still seemed very, very low. So although I don't know if I'd say silver is quote unquote cheap right now, historically speaking to itself, but it seems as though relative to gold, it's pretty cheap. What do you think about that?
The silver bugs are going to hate me for what I say next. But I think the gold-silver ratio is a bit of a factoid. Something that's true, but also something that's irrelevant. In the sense that price ultimately is a function of both scarcity and utility. But it's difficult for me to understand that the fact that silver is 16 times more abundant in the Earth's crust is the determinant of what the price should be. Attempting to price silver accurately by conventional means is very difficult too, because most of the silver that's produced in the world isn't produced in silver mines. It's produced as a byproduct of gold mines, copper mines, lead mines, and zinc mines. So while silver is 16 times as abundant in the Earth's crust, what really matters is how silver is produced. That's the real supply. It isn't the in situ supply, that is silver mixed up in rock or dirt. but rather silver available to consume and sell. So information with regards to supply in silver isn't really a function of the silver price so much as it's a function of the copper price, the lead price, and the zinc price. So I really think that silver is disconnected factually to its relative scarcity or abundance with relation to gold. That notwithstanding, so many people believe in the ratio that the ratio becomes a self-fulfilling prophecy, ironically, even though I consider it a useless metric.
That's incredible insight. I never knew how the dynamics of the actual fundamentals of silver itself, extracting that ratio of gold from the equation. But obviously, I think what you're saying is that's what you would advise investors to do.
One skill set, which has proven valuable that I don't possess, is the skill set of understanding the impact of a story or a narrative on popular culture and hence markets in the near term. As you can see, I can't dress myself without my wife's assistance, and I don't own a television. So my ability to understand the power of a narrative, like relative abundance, and its impact on a market is limited. This has been a failing of mine for 40 years. I'm not trying to overcome it. I just acknowledge it.
Yeah. You got to know what you don't know, Rick, right? All right. Now, I was listening to a podcast you did the other day with Med Faber, and you guys really talked about something interesting from the standpoint. I've never heard you talk about this before, and I think most people would kind of be amazed at how insightful this is. But you talked about how demand in gold is really changing from what you see, and obviously you're right in the trenches, being head of a gold company, and that you see a lot of this demand coming from outside of the United States, but more so with females outside of the United States, and more specifically Asia. And these professional gals that have got out of college are making a lot of money, have a ton of disposable income, and they are now really kind of jumping on the bandwagon for gold. And you see that potentially being a driver of a lot more demand in the future. Do you want to elaborate on that? Because I think just no one's going to hear that anywhere else.
Yeah, it's certainly of interest to me. You know, I've been serving the gold investment community my entire adult life. And for most of my life, I could see my customer base when I looked in the mirror. Old, fat, bald, white, grumpy men. A great audience. I know them well, you know. What interests me has been in the last sort of 2 years, what I would describe as the democratization of interest in gold. At Sprott, we have seen really profound interest expressed in the last 12 months. The other circumstance which has interested me is, and I think this is a consequence of doing interviews like this on social media, when retail investors make inquiry of us and Sprott's investment services, for the first time in my entire career, about 40% of the inbound inquiries are young, as opposed to old. And about 30% of the inbound inquiries are female. If you are looking and dissecting those numbers further, they begin to make more sense. Of the females, a striking proportion of them are South Asian, Bengali, Indian, Sri Lankan, Pakistani, with a long time cultural affinity for gold and an almost inbred historical distrust for government and fiat currencies. So these young women work primarily, at least in terms of the ones who have contacted us, in technology industries. They have high disposable incomes. They have a historical predilection to distrust government, and they have a historic predilection to store savings in gold. So it makes absolute sense that this demographic would show up. I was not smart enough to anticipate it, but mercifully I was smart enough to identify it.
Yeah, that's great. That's very interesting. And I think it's just a lot more tailwind for people who are maybe looking at gold as a speculation instead of insurance. And for those who have it as insurance, hey, if it goes up in value, if you're hedged against the insanity of big governments and central banks, if that gains purchasing power, well, that's icing on the cake. So going back to kind of the investment side of things, and my definition of an investment paying you to own it, are there opportunities within the gold space to buy maybe a stock or that actually pays a dividend? And feel free, if Sprott has those types of products, which I'm pretty sure you do, by all means plug those and kind of let us know if you would see that as an investment, or is that more speculative just because the nature of the gold miners it's such a bad business, to quote Doug Casey.
There has been sort of 5 years of relative fiscal prudence and 18 months of higher commodity prices that have caused these companies to be able to begin to generate a substantial amount of free cash. And some of them have begun to be polite enough to distribute that cash back to its rightful owners. So we're seeing a circumstance where the dividend yield on gold is increasing. I would point out to you as well that for holders of reasonable size amounts of gold, the leasing market exists. The truth is that if you have a reasonably fair-sized portfolio of gold, say $1 million or $2 million worth, you can lease that gold to other holders in semi-secured transactions, and the yield that you get on gold actually exceeds the yield available in a U.S. 10-year treasury from time to time.
You just lend it out.
Yeah, the idea that you have a dead asset is really a function of your willingness to take a credit risk, just like with any sort of bond that you have. We at Sprott have what is for us a fairly large business, a business with in excess of $1 billion in assets under management that is involved in making loans to companies building mines, primarily precious metals companies. And we are looking at launching a product. We don't have this product out yet, but we're looking at launching a product that will involve, first of all, an entity that owns and leases out gold and also buys bonds or preferred shares in gold mining companies and also participates in loans to mining companies. The idea would be to have a product that gave you exposure to the upside in gold at the same time that it gave you what is in today's market an extremely attractive yield. What we try to do in Sprott is we try to design products for our customers that we as partners and principals would like to buy ourselves. For myself at 67, attracted to the gold narrative, but also attracted to getting paid rent on my money, the idea that I have gold exposure with a great yield is extremely attractive to me. And my suspicion is that that product will be extremely attractive to the market as well.
Oh, you got one buyer right here. Do you guys think that you're going to be coming out with this product? And not this is the end of the interview, but how could me or the viewers find out more about that? That sounds really awesome.
Well, it sounds like such a good, fair product that it's probably a felony somewhere. So we're having the product, sort of assembled by lawyers so that it's acceptable in most of the markets that we serve. Our primary market in terms of high net worth retail is the United States, but we're also active in European markets and Canadian markets. So we have to design a product that suits a disparate group of regulators that at the same time is economic and attractive for our holders. We would anticipate, if we're able to launch this product, that we would launch it in the summer. My suspicion is that we will ultimately be successful in launching this product. My hope is that we would be successful in June or July.
Fantastic. Okay, well, we'll leave that as a little teaser for the end of the show, Rick. So I wanted to touch base on gold confiscation. This is a question that I get constantly on the channel, just from the average Joe investor that doesn't know a lot about macro, but just they have a gut instinct that what's going on with QE and the central banks, and they look back at Roosevelt and what happened in the UK and Australia, And a lot of, ironically, in several of the developed countries where they did confiscate that gold, and they get really concerned about that, it's because a lot of them like to hold precious physical gold. Do you have any advice or thoughts on that?
Two comments. The first is that if you're really concerned about that, it's increasingly easy to hold gold outside the United States. If you're nervous about your government confiscating your gold, the easiest thing to do is put the gold somewhere else.
Right.
That is not high among my concern for the following reasons. Your government and your elected legislators get applauded when they steal your money via taxation, or they steal your money via artificially low interest rates, which is, of course, an income transfer from savers to spenders. They get applauded when they steal from your children and your grandchildren by running deficits rather than cutting spending. They don't need to steal your gold. They don't need to steal your IRAs. They don't need to steal overtly. It's so easy for them to steal your money by running deficits, by taxing you, by debasing your currency, and by artificially low interest rates. In fact, it's easy enough that when they steal from you doing that, they're applauded as heroes. They're asked to do more. So the idea that they would steal overtly from you by forcing you to put your IRA in government securities, or as an example, or overtly confiscating your gold, which they were able to do the last time, I don't think that that's likely to occur. I'm not one who is generally guilty of underestimating the venal nature of politicians. I just look at incentives, and a circumstance where they came to steal your gold might bring them face to face with the fact that there are 400 million firearms in private hands in the United States. Which would present a risk to them.
Yeah, that makes a lot of sense. That reminds me of every time I do a gold video that has something to do with confiscation or anything like that. I mean, just nonstop in the comments, I'll just see, they'll take my lead before they take my gold. And to your point.
One of the things I enjoy about talking to the hard money audience is that they make me seem like such a flaming moderate. It's only in a community such as this that I could be described as timid and rational.
Right. They look at you like Paul Krugman, right?
Right.
All right. So next question. We talked about, or you started to touch on how the government steals your purchasing power without you knowing it through inflation. Most of us know exactly how that works and how they lowball the CPI, and that has so many effects. I mean, they pay out less in Social Security. It's just there's a lot of shenanigans that go on there. What do you think about the politicians who are being applauded for increasing taxes on the rich, to your point? What do you think about them implementing some sort of MMT to get around right now we have so much liquidity in the financial economy. I always see them as two separate economies, the financial economy and the real economy. And it's had a relatively hard time, that liquidity, getting into the real economy. But once they institute MMT, then it's going to be a lot easier for the additional $4 trillion going on to the Fed's balance sheet to find its way into the real economy and create the velocity that we know is required with that additional M2 to get inflation really humming. And then when you combine that with them under or lowballing the CPI, that's when they're really stealing from you. Do you have any thoughts on that?
Yes. And let's make sure that we're using the correct vernacular. MMT is longhand for counterfeiting. If counterfeiting were a great idea, they should let everyone do it. When they call it, it's called quantitative easing or modern monetary theory. So I think it's important to define MMT for what it is, counterfeiting.
Right.
with regards to the fact that they will be doing MMT, we suspect at some point in time in the future, what I think is that their interference in the repo rate, the expansion of the balance sheet to provide near-term liquidity, unless we see them draw it out of the market sometime soon, is MMT. In other words, I don't think it's something in our future. I think it's something in our present. And finally,
Right.
with regards to inflation, we need to examine a lot of allegations with regards to inflation. The first, and I'm not an economist, I'm a credit guy. Let's get that clear. But I pay attention to what I spend, and I can tell you that the people who work in the Congressional Budget Office shop somewhere that I don't shop.
Right. Okay.
As an example, on occasion when the measure doesn't include food or fuel, I guess that would be okay if I didn't eat or drive. But as you can tell by looking at me, I do both. Um, uh, so my suspicion is that as it confronts me, the 1.6% number that they use is specious. And of course, that number, the cost of living, from their viewpoint, doesn't include tax. Now,
Right.
if I didn't have to pay tax, perhaps I wouldn't bitch so strenuously about the index. But they've never offered me that inducement to shut me up. The third thing, and this becomes more apparent as you become my age, not your age, is the pernicious impact of what seems at the time to be low inflation. I've used this example many times, but maybe it's new to your listeners. On my way to work every day, I drive past a wonderful establishment called Motel 6.
Mm-hmm.
When I was a young man, I had occasion to stay there, not infrequently. And it was called Motel 6 because a room at Motel 6 cost $6 a night. Today,
I
when
never knew that.
today when I drove by the establishment, the sign said Motel 6, $64.95. In other words, Motel 60. Now, there's only two explanations for this, George. One is that a room at Motel 6 could be 10 times more spacious and 10 times more luxuriously appointed. That's one option.
Right.
The second option would be that the purchasing power of the unit relative to acquiring a room night at Motel 6 could have depreciated by 90% over 30 years. I will admit to having done no recent due diligence on the size or the quality of a room at Motel 6, but my suspicion is that the reason that Motel 6 is now Motel 60 is as a consequence of the deterioration of the US dollar.
Such a great point, Rick. You know, I did a video the other day where I dove into the CPI numbers and how they measured them in the 1970s.
Right.
And when they changed, I believe, 81, 82, changed it again in the 90s, and then how they measure it today. And I did just the back of the napkin math. And or if you go on shadow stats, you can see this.
Right.
And if they measured inflation today, the way they did it in the 1970s, you know, we'd be running about 10%. So everyone knows that. But I think the interesting way to look at it is if you don't believe that, if you're one of these people that say, oh, no, I don't believe that shadow stats, those are just libertarian crazy guys, then you have to believe that the inflation in the 1970s was a lot lower. It's one or the other. You can't have it both ways. And if you believe that inflation in the 1970s was lower, then you have to believe that the real GDP was a lot higher. And if you calculate the inflation back in the 1970s the way that we do today, and then you look at real GDP, it was the biggest boom decade in real terms that we've ever experienced in all of American history. So you can't have it both ways. So as someone who started investing in the 1970s and you lived through that, and you lived through the 80s and 90s, and you're obviously a big part of it right now, do you think the 1970s in real terms was the biggest boom decade that we had? Or do you think that inflation is running a hell of a lot higher than they'll admit to right now. Obviously a rhetorical question.
Yeah, I think without having to go to those statistical lengths, what people need to think about is whether the purchasing power that they have available to them relative to their income suggests that the government statistics are accurate or not. From my viewpoint, and I'm a cheapskate, I don't buy much. From my viewpoint, my purchasing power, even not including tax, although I pay a lot of tax, suggests to me that the purchasing power of my savings is declining by more like 4% compounded at the places I shop, given the goods and services that I buy.
What do you think about the United States, or any country for that matter, going back to a gold standard if we get a kind of a universal currency crisis? Do you see that as being probable or just no chance?
No chance. The idea that the political class would permit something to occur that would reduce their absolute or relative power, I think is something that would never occur. What's useful about gold is that it is discipline. And the last thing that the political class wants is discipline. I think the best that we can hope for is that some of us are able to use gold as a medium of exchange and a store of wealth outside or in a parallel system. In other words, it's up to the United States to save itself. My first obligation is to save myself and my clients. And my suspicion is that I'll put myself, or I have put myself, on a de facto gold standard. The idea that most of my fellow citizenry would join me, I think, is a non-starter. Inflation, taxation, most of democracy looks like, among other things, a battle between savers and spenders, or more precisely, an income transfer from savers to spenders. Given that the spenders are far more numerous than the savers, many aspects of our political culture are popular. You'll recall that old libertarian maxim that an election is a function of 4 coyotes and a lamb voting on what's for lunch. The savers, of course, are the lamb. Now, this is very popular among the coyotes, but the lamb doesn't like it very much. There's a similar quote from Mencken that says that elections are advanced auctions of stolen property. The conundrum that we're in is that the policies that are making us less competitive and less rich are extremely popular.
Yeah, that's very well said. Now, I want to dovetail on that. You talked about the government wanting to continually increase its scope and power. Where do you think the government pushing for a cashless society and potentially going onto a government-backed digital currency, how do you see that playing into the mix?
To the extent that we had a cashless society, the ability that the government would have, or that the collective would have, to cause us to do their bidding, cause us to suborn our private will, or pardon me, our private wisdom is a word that I would prefer to use, to a collective will. I think that would be very, very popular. There is a popular political pundit right now, AOC, who said, I think it was as recently as yesterday, that nobody had ever earned $1 billion, that the billionaires had stolen it. Now, this is specious on its face. People who have made $1 billion have made $1 billion for the most part, unless they cooperated too closely with government. They made $1 billion by finding a hole in the market, finding a need, and filling it with a good or service that people valued more than they valued the money that they spent to get it. The theft has taken place by AOC. by the extortionists. Poll after poll after poll suggests that Americans would not pay tax if there were no enforcement mechanism. If you look at that fact, then what taxes are is the confiscation of freely generated wealth by force or fraud. It's extortion. The only reason it isn't slavery is because thus far the government can't treat you as chattel and sell you. They can borrow against you, which is part of the definition of chattel, but you get my point. And what's alarming about this, from my point of view, is that AOC is, at least among the spenders, extremely popular. So the point of view is that private wealth is somehow a bad thing. It's private wealth that generates the means that carries on the vast array of social services that many people in this country enjoy.
Going back to Eric's done a lot of research on this, and he calls the future digital currency of the U.S. government the Orwell, and I think that's scaringly appropriate. But
particularly if you regard yourself or other savers as the ore. In a geological term, you are the ore body that they seek to mine.
Yeah, that's a good way of looking at it. Like going back to Doug, you're either the milk cow or the beef cow.
Right.
I've heard him say that so many times, and it's so true. Now, I want to kind of leverage the just your extensive wisdom and experience in the investing and just in the United States and being a part of this all. I know that growing up, and each generation always says that this is something new, and we look at AOC as an example, and someone like me that's in their mid-40s, I say, wow, this is crazy talk. I have never heard anything like this before, and I really need to be alarmed. But I know that her message isn't really anything new. I'm sure that back in the 70s, I don't know if Carter was, I doubt he was this extreme, but I'm sure you had some people that may have been extreme. Well, Nader was around then, so he might have been that extreme, maybe in different ways. So my question to you is this just kind of a broken record that comes around every 15, 20 years, or is it really extreme now and compared to how it's been for the last 50 or 60 years?
I suspect it comes around every 5 years. There's nothing that AOC says that Tom Hayden, as an example, or Jerry Brown didn't say out here in California 25 or 30 years ago. The fact is that she's more fun to look at and listen to. So from that point of view, I guess, she's a net benefit. I would like the left to be amusing. And I would certainly prefer to hear her say stupid things to hearing Bernie Sanders or Elizabeth Warren say stupid things not so well. The lovely thing about AOC is she says it all with a smile, right. Maybe just to show her teeth, but I prefer that to the other ones.
Yeah. I've got 3 investment philosophies. Number 1, buy things when they're cheap, some when they're expensive, pays you to own it, diversify with insurance, gold, diversify your political risk and currency risk. So with uranium, I know that is really cheap right now. And although I think we both agree that's a complete speculation, what are your thoughts on uranium moving forward?
Uranium is an investment question where the answer begins with when, and I like that. Most questions have an answer that begins with if. So let me tell you how this works. Even in countries that believe that they're rich enough not to need uranium, like say the United States, uranium accounts for 15% of our baseload power supply. It's estimated by network engineers that a 3% degradation of baseload supply leads to blackouts. So the idea that we can afford to do without nuclear in the next 10 years is a complete non-starter. Now, it costs, according to the International Energy Agency, between $50 and $60 a pound to make uranium worldwide. This number includes cost of capital, and it includes prior year write-downs, importantly. But think about the arithmetic. You make the stuff for 50, you sell it for 25. You lose $25 a pound as an industry, and you do it 100 million times a year. This gets boring.
Yeah.
When I say it's a when conclusion, what I mean is that if the industry for 5 years or 6 years or 7 years doesn't earn its cost of capital, it ceases to be able to produce uranium, and the lights go out. So your listeners need to decide whether it's more likely that the uranium price goes from 25 to 50, or more likely that the lights go out. From my point of view, the former is more probable than the latter. That being said, right now we have surplus supply. And in the next 12 to 18 months, the only hope that I can see for using up that surplus supply would be to increase the pace of Japanese restarts. It's largely Japanese inventory that constitutes that supply. If you see the pace of Japanese restarts increase, you will see the price of uranium increase fairly rapidly. And pardon the pun, it's intentional, you'll see the price of uranium equities explode.
How do you determine whether you want to buy an asset or you want to sell it?
I'm notoriously early. So
Right.
if I tell you what to do on the buy side, ignore me for 2 years. I have a very linear mind. I believe if A is true and B is true and C is true and D is true, that the logical conclusion of that is something. I confuse two words in English, one being inevitable and the other being imminent. So I am always early. I'm a better seller. I'm quite disciplined. Whenever I buy any asset, I write down the reason why I bought it, be it a company, be it a commodity, anything. I write down a reason. And with regards to both investments and speculations, I believe that increasing information associated with my assumptions will make either of them more valuable. If I bought uranium in anticipation of, say, a move to 50 within 3 years, I continue to monitor the market to see whether I'm going to be right or see whether I'm going to be wrong. With regards to an investment in a company, particularly a smaller company, what I'm speculating on is the answer to an unanswered question. And if it appears to me that the answer to the unanswered question is going to be negative, I sell my stock. The reason to own a stock goes away. If the reason to own a stock goes away, the stock must, in fact, go away. I am much better than most of the clients I face at accepting defeat, keeping smaller losses from turning into larger or even gigantic losses. I do, on occasion, sell too early. I suffer from a bit of hubris in the sense that when I determine what I think is fair value for something and it meets that criterion and exceeds it, I tend to sell. And markets tend to go to extreme. Markets tend to use the price information that they receive to justify the narrative, which is to say that when an investment goes from 50% of net asset value to 110% of net asset value, for some reason, investors find overvalued assets to be more attractive because of the price momentum. And those assets typically go to 160, 170, or 300% of net asset value. And leave me looking back, realizing that I came early and I sold early. Buffett teaches, however, that the beginning and the end of a move is not as important as grabbing a fat slug out of the middle. Or even more importantly, Bernard Baruch once said that the only guy who ever bought at the bottom and sold at the top was a liar. It didn't happen.
When you say that, well, I sell a little too early, but you're doing that based on logic and probabilities. You're buying low, selling high. So although you may miss, it may quadruple on you, but who cares? You're not concerned with that. You're concerned with whether or not you made the correct decision based on the probabilities, because if you do that over time, you're going to come out ahead. So my question to you is, in all of your wisdom and experience dealing with people and psychology, why is that so hard for people to do?
I think several reasons. The first is that price action justifies narrative. People
Right.
pay a lot of attention in investing to price. It's easy information to get hold of, and it feels important to you. If a stock goes from $50 a share to $60 a share, you feel good. If it goes from $50 a share to $100 a share, you feel great. Now, arithmetically, if a stock goes from $50 a share to $100 a share, and there's no change in the underlying fundamentals, the stock is precisely 50% as attractive when the price doubles. But people don't
Right.
look at that. The price action justifies the narrative, and price information is easy to get hold of, and an opinion with regards to value is hard to get a hold of. The second problem that we face as investors, in fact, that we face in life, is recency bias.
Yeah.
Events that have happened in the immediate past have more of an impact on our perception of what we'll have in the future than events that have happened in the more distant past. That's why bear markets go to such extremes. You make good decisions, you get punished for them, and you become much less aggressive with regards to investment and reinvestment, particularly in those periods of time when things are cheap. You're getting no positive feedback, and your recent experience is that you've been spanked, and you don't like being spanked. And it's also why bull markets go to illogical extremes. When you make money on your mistakes, you begin to think that the markets are kind and benign, and you come to believe that you're smart and all of those things, none of which are true, of course. So recency bias, I think, is important. You know, it's odd. When many of us, at least, shop for physical goods, we're rational. It's winter now. If you went to buy a coat in whatever part of the country you're in, and you have a price expectation for what a reasonably good-looking coat is that would keep you warm, let's say it's $200, and you go to a store and you see that coat for sale, a coat that you think is reasonable, but you see it for sale at $400, you wouldn't go near it. You'd be angry. You'd think that you were being gouged. If you then walked across the mall and that coat was on sale for $120, you might buy two. In other words, price is a function of utility. But things happen differently with regards to stocks. As I say, if a stock doubles in price and there's no change in the underlying fundamentals, people want to buy more, although it's half as attractive arithmetically. Similarly, if a stock falls in half and there's no change in the underlying fundamentals, people want to sell it in disgust. We have generally rational expectations with regards to physical goods and a very odd set of perceptions with regards to financial goods.
Yeah, that's so well said. It reminds me of the quote. I'm not sure who said it, but they said, everyone knows the price of everything and the value of nothing.
Correct.
And it's just so true.
It's important to note you'll never get it right. You just have to get it kind of right. That's all.
Yeah. I just got one more quick question for you that I know is on everyone's mind. For the average Joe out there, if they see gold as insurance, assuming they're not looking at it as a speculative play, they've got, let's say, a portfolio of 100 grand to maybe $1 million. What percentage of their portfolio would you suggest allocating to physical gold?
There is no one size fits all answer. It depends on what their other assets are. To the extent, as an example, that somebody is a relatively prudent holder of developed real estate and uses prudent leverage with a long-term fixed mortgage, you have some inflation hedge there. You need to own less gold. If, by contrast, your portfolio is mostly long-term bonds, where depreciation of the purchasing power kills you, you need more gold. The lovely thing about gold is that in times of uncertainty, the price appreciation is spectacular. So a fairly small bit of insurance goes a very, very long way. If you look, as an example, at the last decade, the year 2000 to 2010, the gold price moved from about $260 an ounce to about $1,500 an ounce, which is to say that the gold price escalated by 600% over 10 years. If someone had had 10% of their portfolio in gold at the beginning of the decade, assuming that, say, their equities had lost 40 or 50%, in value, gold would have provided an exceptional hedge. One problem that people have that are attracted to gold and precious metals, frankly, is that they buy the narrative too completely. And they, in fact, overinvest in bullion and gold shares. Owning too much insurance diverts too much of your capital from other forms of investment, and certainly from other aspects like starting your own business.
Great point. All right, so it's kind of individual, and each person has to look at their portfolio and see how hedged they are currently against inflation and kind of take it from there.
Correct. I don't think for most people that 10% is either too much or too little, but it really depends on the individual's circumstance and how much liquidity the individual can afford.
Yeah. I think that's a great answer. So, Rick, if we want to find out more about this amazing product that you teased us with beforehand, or if we want to find out more about you or Sprott or any of the products that you guys offer, how would we do that?
I'm going to give your viewers a special incentive.
Great.
For the viewers who are interested in natural resources and precious metals investing, I am going to offer an absolutely no obligation ranking of their securities portfolio. If they email me with the name and symbol in the text, okay, in the text of an email, not as an attachment that my computer guy won't let me open, but rather name and symbol in text, and email that to me at rankings, rankings, at sprottglobal.com. I will rank every stock that I know in their portfolio from 1 to 10, 1 being best, 10 being worst. And I will comment on those securities where I think that my opinion has some value. In addition, if in the body of the text or in the header, these people say product, I will put them on a list to receive information associated with that product when, as, and if the SEC allows us to do it. Further, if they include in either the text or the headline charts, I will send them the Barron's Gold Mining Index 40-year chart, which will show them very properly where we are with regards to gold equities, with regards to markets over the last 40 years. It's a stark, and wonderful chart. And I will also send a 100-year commodity chart, which ranks commodities in valuation relative to several other asset classes, which is also very dramatic. So 3 things we're talking about. One is the rankings of companies. The second is information when available for this gold product. And the third is these 2 charts, with the caveat that I'm no technical analyst. In this particular case, the charts paint such vivid pictures that even a credit analyst like me can understand them.
Yeah, that's awesome. I really appreciate that, Rick. And I know everyone that watches this video is going to appreciate that just as much as I do. So on that note, again, I want to reiterate, it was a complete honor to interview you. You've had such a huge impact on the way I see things, and I'm sure for every one of my listeners and viewers, they would agree. So thank you very much for your time, and I cannot wait to do it again.
Thank you. I'm looking forward to it.